Welcome to Podkey Slopcast, where today's AI boom gets measured against costs, limits, and reality. AI investment is suddenly big enough to move national GDP, and that's the headline. The harder question is whether that means durable economic transformation or a spending surge that still has to prove it can pay for itself. The confirmed data point here is striking. In the first quarter of 2026, AI data centers, hardware and networking made up 1.4% of US GDP, up from 0.7% a year earlier. That's not a niche sector anymore. If the St. Louis Fed attribution holds, AI investment drove 39% of marginal GDP growth over the trailing 4 quarters, which is even higher than the tech sector's 28% peak during the dot-com era. And the sharpest claim is the counterfactual. Without that AI investment, annualized GDP growth would have been around 0.1%, basically stall speed. What that does tell us is that AI infrastructure spending is economically consequential right now. What it does not automatically tell us is that the underlying uses are equally mature or profitable. GDP counts spending, not wisdom. If companies are buying chips, building data centers, and upgrading networks, that boosts measured output, whether those assets create long-run value or not. So the bullish interpretation is that AI has crossed from software story to macroeconomic force. The cautious interpretation is that capital expenditure can lead actual productivity gains by a long time, and sometimes by too much. The comparison to the dot-com boom matters here. Beating that era's investment share is impressive, but it also raises the burden of proof. The internet build-out eventually paid off in huge ways, yet it still involved overbuilding, painful repricing, and a lot of winners and losers getting sorted out after the hype. The next shift is less glamorous, but maybe more revealing. Vendors are moving away from flat-seat subscriptions and toward usage-based pricing because agentic workloads do not behave like normal software seats. One employee asking for occasional assistance is one cost profile. That same employee running autonomous coding loops, long context sessions, and repeated tool calls is a completely different cost profile. That's why examples like GitHub Copilot changes and Google I/O pricing updates matter. They suggest the old bundle price was often disguising a subsidy. Anthropic's reported run rate jump from $30 billion to $47 billion, largely from heavy cloud code usage rather than more seats, supports the logic. Usage pricing creates more revenue when demand is intense. But there's a trade-off. Investors may like that revenue scales with consumption, while customers suddenly get much more sensitive to every workflow and every token. Once the bill maps directly to behavior, experimentation gets harder to justify. The scarcity story fits that. The market appears to have moved from an era where labs were effectively subsidizing very large token consumption, sometimes the rough equivalent of $8,000 to $14,000 a month, into an era where they can't absorb those costs. May and June pricing changes, plus the decline in the Silicon Data LLM Token Expenditure Index, point in the same direction. The easy money phase may be ending, at least for heavy users. Enterprise spend caps make this even more concrete. If a company like Uber or Walmart limits AI spending to something like $1,500 per employee per month, that does two things at once. First, it protects budgets and forces procurement discipline. Second, it shapes what kinds of AI use cases survive internally. When budgets are capped, teams gravitate toward known ROI. Summarization, coding assistance, support workflows, and other measurable productivity tasks get approved. More exploratory agentic systems, where the upside could be large but the path is messy, become harder to defend. That doesn't mean the firms are irrational. If costs are real and outcomes uncertain, caution is normal. But it does mean the market may underinvest in exactly the applications that need room to iterate before they become obviously valuable. So there's a contradiction in the current moment. Macro investment is surging into infrastructure, while micro-level enterprise controls may be narrowing the set of applications that can actually consume that capacity. Once token costs stop feeling free, efficiency stops being a technical detail and becomes a product strategy. Model routing is the clearest example. Instead of sending every task to the most expensive model, firms route simpler work to cheaper models and save premium models for tasks where the quality difference actually matters. Factory says its routing feature saved $13 million in the first 30 days of private preview. Even if you allow for favorable framing, that's large enough to show the savings are not theoretical. The same logic explains why companies are combining open-source or post-trained models, including cheaper Chinese options or custom variants, with high-end models like Opus. DeepSeek and Lindy reporting million-dollar savings fits a broader pattern. The important analytical point is that higher model quality does not eliminate cost pressure. It can actually intensify segmentation. The better premium models get, the more companies want them only where they truly move the outcome. That creates a less winner-take-all market than some people expected. A frontier model may dominate high-stakes tasks, while lower-cost models quietly capture huge volumes of ordinary work. Then there's the adoption problem, which may be more human than technical. The KPMG and UT Austin analysis of 1.4 million workplace AI interactions found that top impact users treat AI as a reasoning partner. They don't just ask for outputs, they frame problems, iterate, challenge the model, and guide the thinking. That's a much richer behavior than basic prompting, and the encouraging part is that it appears teachable at scale. That matters because the education gap is pretty clear. EY says only 28% of organizations think employees can use AI to change business processes. DataCamp says video courses often raise awareness without building confidence. The World Economic Forum warns that AI skills are decaying faster than course catalogs can keep up. So if organizations want more value under spend caps, they probably can't get there just by buying access. They need better usage quality. The prediction that labs will spend more on enablement over the next 6 to 12 months is plausible, but it's still a prediction, not a confirmed trend. The logic is straightforward, though. If customers can't spend infinitely more per user, then labs need either more users or smarter users. Free or low-cost training programs and embedding training into everyday workflow tools would be a rational response. It aligns lab incentives with enterprise constraints. Better user skill can raise realized ROI without immediately raising raw consumption in wasteful ways. The open question is whether that creates more token demand overall, or whether it actually teaches customers to be more selective and efficient. It could do both. The strongest supported story here is that AI has become a major investment driver, while the economics of actual usage are tightening fast. The weaker story is any simple claim that more infrastructure spend automatically means broad, frictionless adoption. The evidence in pricing, routing, and training points the other way. Adoption is happening, but under cost pressure, managerial controls, and a real skills bottleneck. That makes this phase look less like limitless expansion and more like optimization under constraint, which, to be fair, is often where durable markets finally get built. That's it for this one from Podkey Slopcast. The AI story still looks huge, but the interesting part now is where the economics stop being abstract and start forcing choices. This episode was generated by Podkey. Create your own at podkey.fm.